Hello students, Dr. Wang is here recording, and today we are moving to a new chapter, chapter 3, adjusting accounts for financial statements. And this chapter is mainly about dealing accounting accruals and accounting deferrals. And here we have a number of objectives. So we need to learn the importance of periodic reporting, and some companies may have a different time horizon when they do the accounts. And also we will explain accrual accounting and how we should record it when each time comes. And sometimes when the accounting period ends in December, we have to organize everything again, and especially we have to be very careful about dealing with those accruals. And then number 3, we're going to identify the types of adjustments and their purpose in our financial statements. We will also learn a number of analytical skills along with it, and also we will learn how to compute several ratios like profit margin ratio, and also how to use it to analyze the firm's financial performance. If you look at this chart, you will see the accounting period could be recorded as a number of years or a number of months. So the transaction or the reports could occur on a quarterly basis or a monthly basis. Let's say you need to produce your quarterly financial reports every 3 months, and you need to pay your rent every month. And also you will need to pay your bond investors the coupons every semi-annual period or every 6 months, and you will file your taxation every year. So we have a different frequency for different accounting activities or transactions that have influence on our account keeping. First and foremost, we should know what accruals are. So this chart basically is telling you if you're doing something today, or you buy something, or you sell your service or products, you do the activity today and you make the revenue or make the payment, but you will do the payment later. That is called accruals. Okay, like account receivable, the unpaid bills, unpaid rent, unpaid salary, wages, those will be called accruals. And for deferrals is different. That basically means today you get paid or paying others, and the cash got a transaction, the cash got received in or out. So the cash comes first, and then the service will be rendered later. That is called a deferral. So from this chart, you will know that accrual, once again, is an activity happen today, payment later, and deferrals basically means payment happening today and activities later. For unearned revenues, these are more like deferrals. Okay, and now let's explain the accrual accounting and how it plays a role in financial statements. So first and foremost, in our generally accepted accounting principle, aka GAAP, we do our recording on accrual basis and not cash basis. All right, so cash basis is basically says the revenues are recognized when cash is received. All right, you may sell a product today, but you do not get paid today. You will get paid, let's say, 3 months later. Well, so on a cash basis, your revenue is not today, it is actually 3 months later whenever the cash is received. And so that happens to expenses. You may purchase something today, but you do not pay until 2 months later. So under a cash basis, your expense is recorded whenever the cash is paid. And that's not GAAP. That's not how we use in this accounting practice. Instead, we use accrual basis. We put a number for revenue in our general ledger and a journal entry whenever the revenue is recognized. If you have delivered your products or services, then on that particular day, you should put a number for revenue. Likewise, if you have a purchase, supplies, equipment, or land, if you have a spent money, well, I do not say spent money, I would say if you have already make the purchase, then the expense should be recognized. You should put the number on your financial statements today, although you do not pay it until later. Okay, so basically under accrual basis, we record our revenue whenever it is recognized. We record our expenses whenever it is incurred. We do not do the recording based on the time the revenue, the cash from the revenue is received or the cash from the expense is paid. All right, so here is one example. So on December the 1st, 2017, Fast Forward paid a $2,400 cash for a 24-month business insurance plan. Using the cash basis, well, the thing you can see that for a 2-year period, at the beginning of the 2-year period, the entire insurance bill is being paid off. So 2,400 is there, and you will see a cash deduction of 2,400, and then you don't have to pay insurance expense for the next 24 months. But under a cash basis, there's no insurance expense for the next 24 months, right? Because it all get covered due to this big lump sum payment. But on an accrual basis, you will see that $24,000 right there, $24,000 for 24 months, that is $100 per month. So on an accrual basis, which we use in this class, is that we are going to record $100 of insurance expenses, okay, for every month in the next 2 years. And that is $1,200 in 2018 and $1,100 in 2019 and $100 today. So that is the total of $2,400 distributed evenly across the next 24 months. All right. So although we do not actually pay a $100 bill month by month, but we still recognize those insurance expenses as they incurred. Okay. So the expenses match with the periods benefited by the insurance coverage, not the time we pay the cash. For recognizing revenue, so the revenue is recognized. Well, that's going to require revenue to be recorded when goods and services are provided to customers and also at the amount expected to be received from the customers. All right, so it's not just the good you sell, but also the service you render. And based on your goods and services, the customer shall pay you a certain amount. They don't have to pay you now. They can pay you 1 month later or 3 months later. But for now, we're going to say we recognize this revenue as long as the goods and services are delivered and provided to the customers. The expense recognition or matching basically aims to record expenses in the same accounting period as the revenues are earned as a result of those expenses. Now we're going to learn how to identify the types of adjustments and their purpose. So we have 4 types of transactions that extend over more than one period. We have prepaid expenses, unearned revenues, accrued expenses, accrued revenues. And we are going to take 3 steps to record these transactions. The first is to determine what the current account balance would be equal to, and then determine that what current balance should equal to, and then we will adjust the entry to get from step 1 to step 2. All right, so we have this step 1 and step 2. They're pretty close to each other. One is the actual number and another is the proposed number. All right, here let's first analyze prepaid expenses. Well, prepaid expenses is also called a deferred expense. Why do we call it deferred? Again, that is today you get money, the money is paid, and the service will be delivered in the future. Okay, so money comes first, and then transaction or the goods and services will be delivered later. All right, that's why it's called deferred. So prepaid expense are assets paid for in advance of receiving their benefits, like prepaid insurance, prepaid rent, and the prepaid supplies. So if you have a rent of $100 per month, you can pay $1,200 all at the beginning of the year to cover the rest of 12 months. And that will be treated as a assets. Okay, it will be treated as an assets. And under the assets part, you have this increase of prepaid. So each time if the assets got a decrease because of the expense is incurred, then your prepaid expense as a dollar amount in assets will get reduced. For example, if you pay $1,200 rent upfront in a year for a year, and after 1 month, then your prepaid rent get reduced by 100, and that is going to drop to 1,100. And then on the expense general ledger, there is a increase in a rent expense, so that's 100. And for assets, there is also a 100 decrease. And for expense, that is a debit. Whenever there's an expense being incurred, that's a debit. And for assets, your prepaid rent drop from 1,200 to 1,100, then that should be a credit. Now let's look at the prepaid insurance. On December 1st, 2017, the company paid $2,400 to cover insurance for 24 months. That began just today, okay, so which includes the current month. And we're going to record this prepaid insurance because we spent cash, and that cash is recorded as a credit because cash drops. But for prepaid insurance, it actually increased. So you should report a debit for a prepaid insurance. And that is an asset. And that asset hold a value of $2,400. That is coming from the $2,400 cash you just paid. All right. And then at the end of that month, 1 month's worth of insurance just got expired. And then your current balance still $2,400. So what happens is you have this insurance expense incurred during the coverage period of this month of December. So what happens is you will have a $100, which is your insurance expense being recorded under this general ledger for insurance expense, because it's expense, and when incurred, it should be a debit. So you shall see a 100 debit being recorded for insurance expense. And for your assets, well, your assets for prepaid insurance is not worth $2,400 anymore. 1 month has passed. You only have the prepaid insurance for the next 23 months. So in other words, your prepaid insurance is going to drop to $2,300 just because 1 month of insurance has already been incurred. All right, so then that gonna come to this adjustment of $100. So that's basically is $100 credit for these assets. As we know, when assets decrease, that's a credit. So this whole thing, when insurance expenses occurred, have an influence on both income statement and balance sheet. All right, now let's do an adjustment entry for expired insurance. So the general journal adjustment on December 31st and journal ledger account balances are as follows. So what happens is at the end of the month or the year, the insurance expense got a debit of $100, and the prepaid insurance as an asset decrease, so that's a credit of $100. And on the general ledger, so prepaid insurance started with a 2,400, with a deduction of a 100. Now you only have a $2,300. So your coverage, the time of coverage for the future has a shrink from 24 months to 23 months. That's why your asset value got reduced. And for the insurance expense, that's only one number put in there. And now let's talk about supplies. The company just purchased $97.20 of supplies in December, and some of these were used during December. And at the end of the month, a physical count showed that unused supplies equals to 8,670, which is lower than the original value. So what you do here is you have a beginning balance and you have a ending balance, and then you can figure out how much supplies is being used in dollar. So right here, this is your month beginning balance, and that's your adjustment. That's how much supply is being spent, and that's your ending balance. So 97.20 minus 1050 would give you 86.70. All right, and the disappeared supplies are basically used for your production, and that will be recorded as a supplies expenses on your income statement. All right, so now let's adjusting entry for expired supplies, and now let's do the general journal. So what happens here is your supplies dropped from the beginning of the month to the end of the month, okay, by this amount, and there's also supplies expense. So for the journal, you will see the supplies expense have increased, and that's a debit, and the supplies as assets decrease, that's a credit by the same amount, of course. Depreciation. Well, depreciation is a very important topic for this accounting class. Instead of expensing the cost of a plant assets, okay, and we just allocate the expenses across the useful lives or useful years. So we're talking about a building. You buy the building to $100,000, and then you sell the building for $20,000. So the total depreciation is $80,000, and you're gonna spread out and allocate this $80,000 across its useful years. And not just the buildings, it can also be cars, equipment, properties, and plants. And the useful years could be 5, 10, or 20, 15, depending on the feature of your assets. If it's for the equipment handling food and beverage, the assets last for 3 years tops. If it's about office supplies, 5 years to 8 years. If it's about vehicle, it would be 8 years to 12 years. If it's about building, 20 to 30 years. And here it comes to the formula to calculate annual depreciation or depreciation at per year level. So it is called a straight line depreciation. Straight line basically means it's a flat, and that shows your depreciation stay the same every year. So how do you get the annual depreciation? You are going to use assets cost, okay, how much you purchase the machine for, all right, the original price you pay for the machine, minus salvage value, which is the ending value of the machine. After several years of use, after the machine retires, how much money can you sell it for? That is called a salvage value. When you use an asset cost subtracted by salvage value, what you have is total depreciation over its useful life. When you use the total depreciation divided by the number of years in its useful life, that is the depreciation per year. So that's how we calculate the depreciation using straight line method. So useful life, again, is a period of time that assets expect to help produce revenues. And it can expire. We're talking about these assets, buildings, equipment, vehicles. It can be worn out because it will no longer satisfy the needs of the business. You can either replace it, you can just toss it, or you can just sell it in the secondhand market. So salvage value is the ending book value, and that's the expected market value or selling price of the assets at the end of its life. It's also called a scrip value, residual value,